Hello guys, let's look at ledgers and trial balance using Alice principle. Here we have a question. We are told that the following transaction is related to Tony Enterprise. The transactions are given here and we are told prepare ledger accounts and trial balance. In our previous lessons, we looked at the components of income statement and components of balance sheet. You can refer to our videos. And these are the components, some of the components. These are some of the components of income statement and balance sheet. From these components is where we prepare ledgers and trial balance. One thing about double entry or ledgers are prepared using what we call double entry. Ledgers are prepared using double entry. Double entry argues this. So we are saying ledgers using double entry. Double entry argues this. One, that every transaction affects two accounts. Just from the word double, every transaction affects two accounts. Number two, it argues every transaction must be recorded twice. It must be recorded twice. Every transaction must be recorded twice. Number three, it argues that every transactions must have debit and credit. You can see the element of twice again repeated here. This is what we shall be doing today. This is what we shall be doing in this video. So let's look at that. From this illustration, we are supposed to do that. To do this, we shall use what we call Alice principle. This Alice, we shall use Alice. Alice. Alice, A will stand for assets, liabilities, incomes, capital, expenses. In this principle that we are saying, or in this way of cramming that we are calling Alice, we shall say this, that you will debit let me use this pen. You can have increase, can have decrease. When we have an increase in asset, this one will be a debit. This one will be a credit. So we start with debit, credit. Then we end with debit, credit. That's how to remember that. The rest go the opposite way. This is debit, credit. This becomes credit. So here we have credit, credit, credit. Here we have debit, debit, debit. That is what we shall use to do our ledgers. Let's go to the question. The first one, started a business with cash at bank, 4.5 million. One thing you know of double entry, every transaction must affect two accounts. This one, the two accounts being affected here, one is capital, two is what we call bank. So we have identified the two. Why? Because the money we use to start a business is called capital. And this capital is going to the bank account. Bank is under which category? Our categories are here. Bank is a current assets. Since bank is a current asset, increase in asset is a debit. So we shall debit bank. Capital. When we are putting more money in business, the money we are starting a business is increasing. Capital, increase in capital is a credit. So, increase in capital, credit. Do you see we have identified the two accounts affected? We have seen that every transaction must have debit and credit. Now we record twice. Let's record twice. We start here with capital account. You can start with capital account. Start with the capital account, then we have debit, we have credit. Okay? Then we go to, let me start with the bank account. With the interest of space, let me start with the bank account this side, just because of space. Bank account. So here we have debit, here we have credit. Then I will have my capital here. I have debit, I have credit. So we are told to debit bank, credit capital. I'll come to the debit side of bank account and post. I'm saying my figures here are in thousand. I can use these figures in thousands and post this 4,500 on the debit side, because we are supposed to debit bank. The date is 1st of November. Then I give narration. The narration is that this money came from capital. I go to this side, capital, I'm supposed to credit. Again, I show my figures are in thousand. I credit 4,500. On the credit side, I put the figure. The credit side, I put the figure 4,500. Then I have this 1st of November. I have this money, or this capital was injected in the business using bank. Now we go to the next one. Go to the next one. We are told borrowed a loan from KCB Bank, 2.5. When you borrow a loan, the two accounts affected from borrowing a loan, the two accounts affected here, one is the bank, two is the loan account. And this loan account is KCB. So we are saying loan is which category? Liability. When we borrow money, we are increasing liabilities. Increase in liability is a credit. So with this one, we shall credit. When we take a loan, the money that goes to the bank increases. So cash at bank is an asset, current asset. So increase in asset is a debit. Increase in asset is a debit. So we debit bank, we credit KCB. So let us open that account called KCB, or called the loan account KCB. So I'll have loan account, then I can specify this is KCB. Here I have debit, I have credit. My figures are in thousands. My figures are in thousands. So let me debit the bank first. So I come to the bank account, I put 2,500. The date is 3rd November. This money came from what? Came from loan. And I can specify this loan is from KCB. The next one, I am supposed to credit loan account. I post on the credit side 2,500. that is that November, and I specify this loan went to the bank. I specify this loan went to the bank. Specify this loan went to the bank. The next one, we are told this, so this one is done. Paid rent using bank, 200,000. When you pay rent, the account affected here, 1 is the rent itself, 2 is the bank. So, when you are paying rent, rent is an expense. Rent is an expense. It means expenses are increasing, or rent expense is increasing. Increase in expense is a debit. So rent, we debit. When we are paying rent, the money we have in the bank is reducing. Since the money we have in the bank is reducing, cash at bank is an asset. Decrease in asset is a credit. So I'll credit bank. So let me open rent expense account. So I open rent expense account. Okay. So I have rent expense account here. I have debit. I have credit. The rent, we are supposed to debit rent. My figures are in thousands here. My figures are in thousands. So let me debit rent. The amount is 200. The amount is 200. So let's have 200. 200 there. The date is 6th November. Now we narrate how this rent was paid. This rent was paid using what? Bank. Then I go to bank account. On the credit side, I'm supposed to credit. I write here 200. Then I have what? 6th November. This money in the bank went to pay what? Rent expense. Went to pay rent expense. We go to the next one. We are told this. We withdrew from bank 1 million for office use. When we withdrew money from bank for office use, the two accounts affected is 1, the bank itself. 2, we have the cash. Cash in hand. Cash in hand is an asset. When you withdraw money from the bank and put in cash, there is increase in cash. Increase in asset. Increase in asset is a debit. So this cash will debit. The bank is losing money and it is an asset. Decrease in asset is a credit. So we'll credit bank. So let's withdraw 1 million here. So this is on 7th. So we are withdrawing. This money went to cash, 1 million. Let's deposit to the cash account. I open a cash. Account. When I have debit, I have credit. So I want to deposit now to debit the cash account. On the debit side here, I post the 1 million. And I narrate, give the date 7th of November. This cash came from bank account. Came from the bank account. The next one, bought stock using check, 1.5 million. We are buying stock. When we purchase stock, we are purchasing an asset. But purchase of stock is written in an account called purchases. So here we have two accounts affected. The two accounts affected by this is 1, purchases. 2, this stock is being purchased using check. So this will affect the money we have in the bank. So for purchases, we are purchasing stock, is a stock account. So stock is an asset. So increase in stock is increase in asset, which must be debited. So these are debit. Therefore, we are also losing money, which is an asset. Decrease in asset is a credit. So let's do this. So we have this. Probably I can draw it lower. We have this. So we have purchase account. So we shall have debit, we have credit. So we are supposed to debit purchase account with this amount. So I have 1,500. This was bought on 10th November. 10th November. This was bought using what? Bank. Then I go to bank account and the credit, the same. I record it twice. I have 10th of November. I indicate this is purchases. Purchases. The next one, we are told paid for electricity using cash. 50,000. Electricity or all utility bills are expenses. So when you pay for electricity, it means you are paying for a bill and you are increasing expenses, which is a debit. So the two accounts being affected by this, one is electricity, the other one is cash. So since we are paying an expense, which means the expense is increasing, increasing expense is a debit. So we'll debit this. The cash we have is decreasing. When you pay, money reduces. Cash is an asset. So decrease in an asset is a credit. So this will become what? A credit. That will become a credit. Yes. So that means you credit cash account. What we don't have is electricity. We already have cash account. So I open an electricity account. An electricity account. In this electricity account, I also put debit, I also put credit. So the amount is 50. So we have the figures are in thousands again. So here I write 50. The date is November 15th. So 15th of November. This was paid using what? Cash. I go to cash account and also post 50. So I say 15th of November, we have electricity. 15th of November, we paid for electricity. So that is done. That is done. We go to the next one. Sold goods on credit to Tom. Sold goods on credit to Tom. When we sell goods on credit to Tom, the two accounts being affected, one is the Tom. One is Tom, the person receiving the goods, and we also have sales. These are the two accounts being affected. Out of these two accounts being affected, one must be debited, one must be credited. So Tom here, when we are selling, when we make sales, we lose stock. Since we are losing stock, and stock is an asset, decrease in stock, which is an asset, is a credit. So we must credit this. Tom is receiving an asset, or Tom is a debtor. Debtors are those customers who buy goods on credit. So that means our debtors are increasing. Increasing debtors or assets is a debit. So we'll debit Tom. Just take note, every transaction must have a debit, it must have a credit. Once you know one account which is debited or credited, automatically the other one, if one is debited and you are sure, automatically the other account is credited. So let's open the two accounts here. So we shall open one, Tom, and we can specify as a debt account. And here we have debit, here we have credit. These figures are in thousands, the figures are in thousands. So what we have sold is 1,800, so we have 1,800. The date of this is 19th November. These are sales. Then we open a sales account. We put a credit, we put a debit here. And we, again, this was a debit, so this other one will become a credit. So we credit 1,800. We talk about the person we sold to. The person we sold to Tom. So we are done with that one. The next one, received rent via cash, 400,000. When you receive rent, that is an income. You can't record it here. You don't mix incomes with expenses. So rent, we open another account called rent income account. So we'll open what we call a rent income. When we receive rent, it means our income is increasing. It means our income is increasing. Increasing income is a credit. So automatically we know rent income will be credited. Increasing income is a credit. So rent will be credited. So I will credit rent income, the 400,000. And since you are receiving money, sorry, let me write the date first, 25th November. This rent was received in form of cash. Since you are receiving cash, I'll come and record and say debit, increase. Increase in cash, which is an asset. I debit here. We have 25th. We received the rent income. 400. The next one. 29. Tom paid a check of 1,700 after receiving a discount. This is one of the tricky questions that you can be asked. So here we have two transactions in one transaction. One, the payment of 1.7. This payment one is affecting two accounts. This payment is affecting Tom, and it is also affecting our cash, our bank, because we are receiving a check. When you receive a check, we debit bank because increase in cash at bank increase. The money we have in the bank, we are receiving money from Tom. So our cash is increasing. Increase in cash at bank is increase in asset. It's a debit. Tom, we are reducing our debtors here. So decrease in debtors is a credit. So we credit Tom. And this is by the 1.7. Take note, we have one transaction, two transactions in one sentence. This one for payment and this one for discount. So we'll record it this way. We record this one first. So let's debit bank. So we come to bank and we write 1,700. The date is 29. 11th. We say this came from Tom. We go to Tom. We say 29, 1,700. He made payment using what? Bank. Now, we also have to record the discount. Discount, here we are allowing discount. Discount allowed. So one of the account being affected is discount allowed. And the person being given discount is Tom. The person being given discount is Tom. So now, discount allowed is an expense. When you give discount, you are increasing this expense, which is called discount allowed. So increase in expense is a debit. So we shall debit discount allowed, and we shall credit the person who got the discount, because we are reducing the debtors. So we come here, let's credit, let me open a discount account here. I can open here, discount allowed. Account, then I have a debit, I have a credit. I'm supposed to debit discount allowed, so I come and write on 29th November, I say the discount allowed, this discount was given to Tom, the amount is 100. These figures are in thousands, figures are in thousands. Then I go to Tom, I credit Tom, 29th, 11th, discount allowed 100. If you can have a closer look at Tom's account, you see we sold goods worth 1,800. Tom paid us using bank 1,700, and we gave him a discount of 100. Total here is 18, total here is 1,800. That means Tom is not supposed to pay us anything. Let's go to the last transaction. Paid salaries and wages using check, 300,000. I can grab this. So salaries and wages, here they are expenses. So we debit salaries and wages just the way we have done with other expenses. We have salaries and wages. Debit, credit. So let's debit salaries and wages. We debit salaries and wages. Now, the amount we paid is 300. So we write 300 here. The date is 30th November. We paid this using bank. So I write here bank. Then I go to bank account here and credit and say the money is reducing. So 300. So we have also 30th. We write salaries and wages. So we are done with recording all these transactions. What remains is us to balance off these accounts. So we can balance off the accounts. Let's balance off the accounts. Let's balance off the accounts. We'll balance off every account here. So I can start with these ones. Here. So here, the total is 300,000. As you balance, the total is 300. I want this side to be 300. So it means this way that here we'll have balance carried forward of 300,000. Again, I do this same to this. Tom is 100. I want this side to have 100 also. So I will put balance carried forward 100. So here we have 100, 100. This side, the total is 400. This side, I want the total to match as 400. So I put what we call balance carried forward 400. Again for Tom, I do the same. For Tom. Total is 1,800. 1,800. So I put a balance carried forward 1,800. Again, for Tom account, sorry, this was sales. For Tom, the total here is 1,800. The total is 1,800. We don't have a balance carried forward. No balance carried forward. The next one, and come here, I say we have this, the total is 4,500. I can also write here 4,500. So here, what we have is a balance carried forward 4,500. The next, we have this. The total here, 2,500. I want this side to be the same, 2,500. That means our balance carried forward is 2,500. The same again here. I want to put these sides to have the same balance. Balance carried forward, 200. This we shall have 200. Again, 200. Here we have 1,400. I want this side to have 1,400. Therefore, balance carried forward is 1,350. This side, again, I do the same. 1,500. This side, 1,500. Therefore, balance carried forward, which is the difference, is 1,500. This side, yeah, 50. I want to have this side. On this side to have 50. Therefore, again, balance carried forward is 50. Let's go to the bank account. Bank account. Let me use a calculator. So here we have 4,500 plus 2,500 plus 1,700. The total here is 8,700. I want this side to be 8,700. So I minus 200. I minus 1,000. I minus 1,500 and I minus 300. This side has 5,700. So the balance carried forward is 5,700. We are done balancing off the ledgers. What remains is us to do a trial balance. What remains is us to do a trial balance. Let's do a trial balance. Let's do a trial balance. I'll do a trial balance here. Let's do a trial balance here. So the name is Tom. Tony Enterprise. Trial balance. Is at November 30th, 20, can use that. So, let me use this. For trial balance here we have a debit, here we have a credit. Here we have a credit. I want us to do this trial balance. How do we do trial balance? For us to do trial balance, we must get balances brought forwards. For us to do trial balance, we must get balance brought forward. Balance brought forward comes to the opposite side. So here we have the balance. Just a minute. Here we have balance brought forward. It's this amount, 5,700. Here again we have balance brought forward, 4,500. Here we also have balance brought forward, 2,500. Balance brought forward, 200. Balance brought forward, 1,350. Balance brought forward, 1,500. Balance brought forward, 50. That is how we write the balance. Now, this one doesn't have a balance brought forward. It does not appear in the trial balance. This one will not appear in the trial balance. We only record those that have balances brought forward. So we have balance brought forward, 1,800. Balance brought forward, 400. Balance brought forward, 100. Balance brought forward, 300. Let's look at this. So now we get all the balances brought forward. Let's have this. It's on the debit side. So we take it on the debit side. So we just write bank 5,700. We go to this capital 4,500. The next one, loan. It's on the credit side, so it still goes to the credit. Loan 2,500. Remember our figures are in thousands. Our figures are in thousand. We have rent 200. It's on the debit. Rent expense. Rent expense is 200. We have cash on the debit. Cash is 1,350. We have purchase on the debit, 1,500. We have electricity on the debit. This will not appear anywhere in the trial balance. We have sales on the credit. Sales is 1,800. We have rent income. on the credit. Amount is 400. We have discount allowed on the debit. Discount allowed is 100. Discount allowed is 100. We have salaries and wages still on the debit, 300. Let me get a calculator to see whether it is balanced. So we have 5,700 plus 200 plus 1,350 plus 1,500 plus 50 plus 400. So this is 9,200. And look at the total for this other side. 4,500 plus 2,500 plus 1,800 plus 400. The total is 9,200. You can see that our trial balance has actually balanced. In our next video, in the next few videos, we shall be looking at correction of errors. When the trial balance does not balance, it means you have committed an error. And we shall be looking at that in the upcoming videos. But sometimes the trial balance can balance even with an error. So we shall look at the two scenarios in the upcoming videos. For now, this is how you do the ledgers. This is how you extract the trial balance. Remember, today we have used Alice. Thank you.